The much more important thing that's happened in particular in high yield is the relative lack of issuance. So I run a high yield fund, for example. A typical high yield fund will generate about 25% of its cash AUM in returned principal every year. That's a combination of bonds that are maturing and receiving cash for those. And the coupon, which is currently about 7%, is going to be tacked on top of that. So you end up with somewhere in the neighborhood of 20 to 27% of the cash being returned every year. When there's not a lot of new high yield issuance, that actually creates competition for the secondary securities that are trading, which is just another way of saying if credit spreads tighten. This has been an extraordinary period where the credit issuance has not come anywhere close to the credit issuance that existed in 2020 and 2021. As we move to kind of the traditional maturity profile of high yield, that 5 years out from that point, you're seeing that there's a mixture of a shortage of high quality secondary securities in the high yield space. That means either you're stretching for yield by buying lower quality stuff, further compressing credit spreads, or it means that you're chasing after the existing high quality stuff, i.e. tightening credit spreads. The companies are much more worried about the level of interest rates than they are about spreads at this point. But the simple reality is that the secondary market liquidity in high yield is relatively strong because there is so little product that has come to market.